Well, Cyient DLM, that's a stock that's taking a hard knock in today's trading session. The consolidated revenue looks good. However, the standalone revenue growth appears a little bit tepid, and profitability has been impacted by a couple of one-off costs. To understand what went on in the past quarter, what's the way ahead, we're joined by Mr. Anthony, the Chief Executive Officer of the company. Hi, Mr. Anthony. Good morning, and thanks a lot for joining in. Well, give us a few details. If I look at your growth, it looks good, but that's more because of the inorganic growth. I recall you have been maintaining that you will be growing by 30 to 40%. So could you tell us what is the reasoning for this weakish standalone revenue growth, point number one? And margins were impacted in the past quarter because of a couple of one-offs. What do the margins look like from quarter 4 onwards, because those one-offs will not be there?
Well, nice to be here. So regarding some of the organic business, that business is good portion of that does come from sectors including aero and defense, where some of those programs, especially newer programs, can shift in timing and also on award of those deals as well. So as we've indicated in the past, this can be a bit lumpy in those sectors, and but the outlook in those sectors has actually been quite strong. For A&D, that's where we have seen a good amount of our growth from our current client base. But there also has been in some of the other sectors, such as industrial and a little bit of medical, where we've had some softness there. And we have new programs coming up to try and mitigate that here in the coming quarters. Also, just regarding the profitability of it, obviously that's tied a big part of it due to client mix, program mix. We are currently shipping a very large defense program that is a little bit lower. It is lower margin than the rest of our portfolio. We'll complete that program next quarter, and then our profitability and mix, our profitability due to the client mix should improve after we complete that program.
So let's get this simplified. There were a couple of shifts, in some of the sectors that you work with, and there is an order, a large order, defense-related order that has impacted the margins that will end in the next quarter itself. So
that's correct.
This year, by the end of this year, where do you see your annual revenue growth? And for the next year, once the lumpiness is taken out, etc., what is the growth that you're targeting on your top line, and what is a normalized margin for you?
Yeah, so starting with the top line, we've tried to provide just some rough guidance, not specifically years, but just more of a CAGR over multiple years. We like to see it about a 30% growth. I think the year before we had over 43%. This year will come in less. Next year is still forming. So still over the midterm, that 30% year-on-year growth is where we like to be, which is in line with the sector as well. But again, that will vary quarter to quarter and even during parts of the year. Regarding the bottom line, we look to operate the business at about a 10% EBITDA, and that is a solid, really a solid baseline for the business that will, that can vary again quarter to quarter. But even as we go forward and as we have a higher concentration of business that is higher margin, we actually expect to see upside from that, and especially as we deliver the programs they have designed.
Okay, in the past you have been speaking about double-digit EBITDA margins by FY26. Is that on?
Yes, that is very much where we should be delivering. I think we'll definitely be there by FY26, if not even completing this fiscal year at that level.
Oh, all right. So maybe towards the end of this fiscal year as well, you'll get closer to around the double-digit mark. And in FY26, you're saying for the year, it'll definitely be in double-digit margins, right?
That's how we are trajectorying the business at this time, yes.
A quick word on the order book. You had told us that the second half of the year is going to look very, very strong. The order book, well, it's holding at around that 2,150 crores odd. On a year-on-year basis, it's still a little bit lower. Could you tell us, you have won some orders, I think, post quarter 3 as well. So where do you expect to end the year with in terms of order book?
Yeah, so order book that is again dependent on a few key strategic deals that as we close those deals and as those orders come in, you will see the order book have the impact in that regard. And so and again during this year we have been delivering for most of the quarters record revenue, and that's had some impact as far as consuming the backlog that we have. But the order book will come in here as we secure some of these larger programs that we have targeted. We hope to be able to announce those in the coming quarters, and that will provide some positive momentum in that regard.
Just a couple of questions before we let you go on the order book itself. First, you said that you are looking to get in some order wins, etc. If you could give us a aspirational target of what are the kind of inflows that you're looking at in the fourth quarter and the next financial year. And the second part is on Altech. If you could give us a sense of how much of the business has scaled, what's the aspiration here, and what could the synergy benefits be?
Yeah, absolutely. I'll start with the Altech piece, as that has really positioned us quite well. Again, this is the first quarter that we've had them as part of the operations. There's already a good amount of synergy happening from a client perspective. Recent political momentum has also had that U.S. operation ability be very interesting to our clients, as that opens up many opportunities. So Altech has actually had similar bottom line and recently even top line performance to what we've delivered on. So we see it as quite complementary to the overall business, and we also see it as an area where our current clients will find a very similar DNA and type of operation in Western markets than what they're experiencing with us today in India.
Does Altech hit $50 million of revenues? When do you think?
So we don't break down the specific numbers for that, but the business has currently been at a run rate just a bit shy of that. But again, we do see a robust outlook for that business. Absolutely.
Ask you about that because it's done around 35-40 million in the past. So the street would like to see that scaling up, as you've been saying. Tremendous potential, but it needs to show in the numbers. Thanks a lot, Mr. Anthony, for joining in and filling us in with those details. You're sounding reasonably optimistic. For the time being, the street is disappointed with the past quarter's numbers, but 30% revenue growth with double-digit margins is what they'll be looking forward to in FY26. Well, stock is down close to around 13% or thereabouts. Let's look